And how are you thinking about this? I mean, the jobs number today, certainly strong on the headline, but enough slowdown internally to make people think the soft landing is not out of the question. The Fed's told us in the last few days, perhaps they're willing to skip, even with the economy strong, skip a rate hike. And, you know, we had the tech leadership, and now maybe it's starting to broaden out. So what's wrong with this picture?
Well, it certainly is encouraging that for the first day in a really long time that the rally isn't just a handful of names and a handful of tech names. And to see names like Caterpillar up 7-8% today, energy stocks up 3%, that's really encouraging and a sign that maybe this fear of having a very sharp slowdown in the very near term isn't happening, supported by the economic data we got today, as well as the China stimulus. And I actually think that is what's behind a lot of these moves in the cyclical names, because if we see more economic support out of China, good for commodities, good for these value names that have been really beaten up and really left for dead all year long.
They have. I mean, there's a way of describing what's been going on this year as taking the main complaint of the last few months, which is it's been an incredibly narrow rally, the upside driven by just a small handful of growth stocks, as saying, well, that's the market's way of kind of pricing in some slowdown risk into the rest of the market. Other sectors have not done a lot. Therefore, expectations are low. And if the economy's firmer, they can start to take up some of the slack.
Yeah, I mean, look at that equal weight index trading at 15.5 times earnings.
Yeah.
That's not pricing in anything aggressive. However, if you look at the growth sector or the technology sector, you're trading at 26, 27 times earnings, and you're actually back to territory that we've only seen those valuations when the Fed is actively easing. And so there is a point that some of these technology stocks, in addition to AI optimism, they have been pricing in a weaker economic environment and easier Fed policy. I think what's interesting about the Fed's commentary, even this backing off of a hike in June, is that even the most dovish members are not talking about cuts. And so it will be interesting when we get into the June meeting how they parse that gap between what the bond market is saying they will do and what they're saying they will actually do.
Right. Presumably, they're going to have to update their economic outlook to account for the fact that the market is, the economy is not slowed down as much as they might have thought. What it means for their target rate for the Fed. I guess right now the market's just saying, look, we're in the zone of where they said we're going to get to. There's some relief in that. But how would you be looking to either participate in what's going on or, you know, use it, let's say, even to get more defensive, or how to navigate it?
So we have been buying equal weight and value. That's where if we're looking to put new capital to work, we've been focusing on those parts of the market instead of chasing the growth rally. If you look at growth in the NASDAQ, it is overbought in the short term. Now, momentum in the short term doesn't mean that the trend upward is over. It just means that you might have a little bit of a digestion period. So instead of chasing that today, we've been adding capital into the equal weight and value indices and actively purchasing names in those areas with a lot more valuation discipline.
And I guess the question is, what's the next thing? We seem to be kind of hopscotching from one thing we're worried about to the next, right? It's either, we're headed right for a recession, or the numbers were too hot in January. The Fed's going to have to go to 6%. And then it was debt ceiling. And then it was maybe an earnings collapse. A lot of them we've managed to weave around. And then, of course, now we have folks saying, well, now that we have a debt ceiling deal, it's going to be a big, huge rush of Treasury issuance, and what's that going to do to yield? So, in a way, it's good to have the wall of worry in place, but what do you think is the next thing to challenge this market?
I think it is exactly that last point, which is that we have seen liquidity be a very big beneficiary for stocks this year because of the drawing down of the Treasury general account. And Dan Clifton over at Strategas calls it Yellen's bazooka, meaning it's bigger than QT. It's actually offset all of QT this year, this spending of cash by the Treasury. And so when that reverses in the other direction, you lose a tailwind for this market. And it helps to explain why valuations are so high for growth in tech stocks, because they benefit the most from that liquidity. So as you pull that liquidity away, you see a rebuild of the cash balance that could be an important headwind and a source of rotation from growth into value.